Good morning, and welcome to episode 174 of Getting Rich. I'm your host, Rich Checkan, president of Asset Strategies International, and today is Wednesday, May 15th, 2024. From time to time, I like to do a little bit of a departure. Today, I don't want to touch prices at all. I think sometimes we get wrapped up too much in prices. Every now and again, I just like to take a little bit of a deep dive into a concept and spend a little time with you explaining the dynamics of what's going on in the market. And today, I want to do that with silver and its relationship to gold. A lot of people may have noticed that silver has been lagging gold for quite a bit over the past several years. In fact, as gold was consolidating for 4 years at all-time highs, ready to go higher, silver was consolidating for 4 years as well, but only at half of its all-time highs of about $50 an ounce. Well, why is this happening? Well, in the precious metals complex, gold is your leader. It's the first to move. So when we're leaving a bull market heading into a bear market, gold is the first to make that move. Silver will follow and tends to be a bit more volatile, so it will outpace gold to the downside. When gold turns that corner and starts moving back up into a bull market, silver will follow after a little bit of a delay. We've seen that lag, and then it tends to be more volatile and outpace gold to the upside. And the result is an impact on that gold-silver ratio we quote every week, the number of ounces of silver it takes to buy an ounce of gold. So when gold and silver are both at low prices and silver has fallen further than gold, it takes more ounces of silver to buy that ounce of gold. Then, when the bull market appears and they start going up and silver moves higher faster, now it's going to take less ounces of silver to buy that ounce of gold. And we've seen that, just a few years back, it took 127 ounces of silver to buy 1 ounce of gold. And today we're about 86 or so on the index for the gold silver ratio. So we're seeing that play out. But silver tends to be your choice for profit because of that very dynamic. It moves lower in the bear markets than gold does, and it moves higher in the bull markets than gold does, so it has a greater potential for profit from the low to the high. Makes common sense. So silver consolidated, like I said, for about 4 years at half of all-time highs at about $25 an ounce or so. It got most recently up to about $29.50 or so, and then it fell back as gold fell back. So gold had moved up about $600 in about 2 months' time, and over the past month we've seen it come back about $100 an ounce. For silver, it's come back about $2 an ounce, so we're seeing the same retracement, profit taking, maybe a little bit of reaction to the Fed's comments about higher for longer, but I think really we're seeing some profit taking. People had seen some good gains in a short period of time and they cashed in. It's just common sense human nature. The last bull market, gold from trough to peak went up about 650%. Silver from trough to peak went up about 1,000%. Okay, so we want you to be your own central bank, to take care of your finances, protect your assets with wealth insurance by buying gold. We also want you to be your own silver stacker for that profit potential in silver. I hope this helped some of you understand that relationship between gold and silver. As always, we'd like you to go ahead and subscribe to our YouTube channel, like us, send us your comments and questions, subscribe to our twice weekly Always Something Interesting alerts and our once monthly information line newsletter. But don't ever forget that getting rich starts with keeping what's yours.